Have you ever found yourself, staring down a big financial decision? Maybe buying a car or trying to figure out student loan form.
Oh, definitely.
Or just trying to untangle your credit score.
Yeah.
And wishing someone had just really taught you all this stuff back in high school.
It's such a common feeling.
Or maybe you did have a finance class, but you're still wondering, did it actually stick?
Yeah.
Or was it just another box to tick off?
Exactly. And today, well, we're just absolutely swimming in financial advice, aren't we? Blogs, podcasts, social media. Everyone's got an opinion.
Yeah, it's everywhere.
Yeah.
Your relatives chiming in.
Right. It's just this wall of sound, this cacophony. And it makes it incredibly difficult to know what advice is actually, effective, what genuinely helps with real-world financial behavior.
Versus just adding to the noise.
Precisely.
Right. And that's exactly why today we're doing a deep dive into something really fascinating. It's a rigorous study from the Federal Reserve Board that tries to cut through all that. This isn't just another theoretical discussion or asking people if they think financial education is good.
No, this is different.
This research actually drills down into the measurable, the tangible effects that mandatory personal finance classes in high school have on young adults' real credit behavior. What actually happens?
So our mission today really is to unpack this central question. Do these required high school finance classes actually make a concrete, measurable difference?
Yeah.
Do they change how young adults manage their money, their credit? Or are they maybe just a well-intentioned idea that doesn't really work in practice, just another thing crammed into a busy schedule?
What's the real impact on things like credit scores, avoiding debt, that kind of stuff?
Exactly.
And you should prepare yourselves because the findings we're about to unpack are, they're significant, but they also hold some pretty surprising insights.
No.
Yeah. For anyone interested in policy or education or even just, getting a handle on your own finances, it turns out that when a financial education policy gets put into action, the timing, and how the curriculum is actually delivered in the classroom, that can be even more important than just if it's implemented at all.
Interesting. So the execution matters more than the idea itself.
It seems so. It's all in the nuances, the details of how it's done. And this study really digs into those details. It gives us this rare glimpse into what actually works. Okay, let's unpack this a bit first. Before we dive into the surprising findings and the study's cool methods, let's set the stage. Why is there such a big push for financial education in schools anyway? Feels kind of recent, maybe.
Well, yes and no. The push has definitely intensified, but the underlying problem isn't new. The sources we looked at are really clear. There's a well-documented, persistent issue driving this urgency. It's this broad, consistent correlation. Lower financial knowledge is strongly linked to, concerning financial behaviors.
Okay.
It's not just a hunch. There's a lot of research showing that when people have lower levels of financial literacy, it leads to a whole bunch of negative outcomes.
Like what kind of outcomes?
We're talking tangible stuff. Lower rates of planning and saving for retirement, for example. Less wealth accumulation over time, which really hurts long-term financial health.
Right. Missing out on growth.
Exactly. And also lower participation in the stock market. So many people miss out on potentially significant growth opportunities.
And it's not just about missed opportunities, is it? The sources mention more immediate problems too, things that can really trap people.
Absolutely. Lower financial literacy is also directly tied to higher rates of using things like payday loans, title loans, those alternative financial services that often come with sky-high interest rates.
Yeah, the really costly stuff.
And it's linked to just generally higher levels of consumer debt overall. So it paints this picture of people making decisions that seriously undermine their financial stability, often piling up unnecessary costs, maybe without even fully grasping the long-term consequences.
And when we talk about who's most at risk here, who struggles most with this literacy gap, the research seems to really point towards young adults, right? That feels intuitive. They're just starting out.
It does feel intuitive, and the data absolutely backs it up. Young adults are a major focus for policymakers and researchers.
Why them specifically?
Well, studies, like one from Lusardi, Mitchell, and Curto back in 2010, found this group has particularly low levels of financial literacy compared to older folks.
Okay.
And on top of that, research from the Finer Investor Education Foundation in 2013 showed they're also really prone to using high-cost credit. Think carrying big credit card balances month after month, paying loads of interest, racking up late fees.
Ouch.
Yeah. So you've got this combination. low knowledge, and a tendency towards risky financial behavior. It makes them pretty vulnerable right as they start making big financial decisions. College debt, first car, credit cards.
So, okay, we have this clear literacy gap concerning behaviors, especially among young people. How did policymakers react? Was there like a trigger event that really pushed this onto the agenda, made them say, okay, we need to put this in schools?
There really was. The study points directly to the 2008 financial crisis as a major catalyst, a real galvanizing moment.
Ah, okay. That makes sense.
It apparently further galvanized public sentiment for improving financial literacy. Suddenly, in the aftermath of all that instability, you saw this surge of activity. Presidential advisory boards popped up, governors' councils, state and federal commissions focusing specifically on financial literacy.
Right. A big reaction.
Definitely. And the core belief driving it all was this idea that, quote, better informed consumers might engage in more prudent financial behaviors and avoid behaviors that could trigger broader economic problems.
So basically teach people better money habits early on to prevent another big crisis down the line.
That was the fundamental rationale, yes. Equip individuals to make sound choices from a young age.
Okay, that seems logical. You'd think with all that momentum, the clear need, the crisis, the research would just overwhelmingly show these school programs working miracles.
You would think so, wouldn't you?
But here's where it gets really interesting and maybe a bit, I don't know, frustrating if you're looking for simple answers. The sources say that previous research on whether financial education actually works has given us, well, limited, even mixed results.
It's true. The picture was surprisingly murky for a long time.
Which feels counterintuitive. Why? What made it so hard to evaluate these programs properly? Why couldn't researchers see a clear impact?
That's a fantastic question, and it's exactly why this particular study we're digging into today is so valuable. One huge challenge was something the authors call heterogeneity.
Heterogeneity meaning?
Meaning the programs themselves were all over the map. When earlier studies compared states with financial education mandates to states without them, they were often lumping together vastly different approaches.
Okay.
So one state might have an intensive year-long course with tough exams. Another might just, recommend some finance topics be covered, maybe without even a specific graduation requirement or much guidance on what to teach.
Right, so it wasn't a fair comparison.
Not at all. Trying to find an average effect from such a mixed bag, it can easily water down the impact of the really strong programs.
Yeah.
You end up biasing the results towards finding nothing because the good stuff gets averaged out by the, less rigorous stuff.
It's like trying to judge the effect of exercise by looking at people who run marathons and people who walk to the fridge and just averaging it all together.
That's a great analogy. Exactly.
Yeah.
You lose all the nuance.
Okay, so that's one big problem. What else made it tricky?
Another absolutely critical issue was timing. This is a huge point many past studies kind of missed.
Timing. How so?
Well, a state might pass a law mandating financial education, but then there's often a big gap. A time lapse, the study calls it, between the law passing and the program actually being fully implemented in classrooms across the state.
Ah, okay. It takes time to actually roll it out.
Years, potentially. You need to develop the curriculum, train teachers properly, get schools equipped and ready. It doesn't happen overnight. But many earlier studies just used the date the law was passed as the start date for when students were supposedly getting the education.
Oh, I see the problem.
Yeah. If students are actually receiving the education when the study thinks they are, then your estimates of effectiveness are going to be way off. You'll seriously understate any real impact.
You're measuring something that hasn't even properly started yet.
Exactly. It's like judging a cake before it's even baked. Of course it doesn't look good yet.
It's a huge flaw.
Yeah.
Okay, so program variety, bad timing, anything else?
Yes. There was also what they call the aggregation problem.
Okay.
Financial education mandates don't happen in a vacuum, right? They might happen at the same time as other big school reforms, or during major economic shifts like a recession, or when new student loan policies come in.
Lots of other things changing at once.
Precisely. So if you're just lumping together data from many states over many years without carefully controlling for all those other potentially influential factors, it becomes incredibly hard to isolate the effect of the financial education alone.
How do you know it was the finance class and not, say, the economy improving slightly?
Exactly. It's really tough to pin down causality when so many things are moving at the same time.
So basically, previous research was messy, the programs were too different, the timing was often wrong in the analysis, and other factors clouded the picture.
That's a good summary. It really makes the case for a much more precise, targeted approach, which is what this study tries to do.
And we also have to talk about the elephant in the room, right? School time is limited. It's precious.
It absolutely is. And the sources are very direct about this. Adding financial education, they say, quote, could come at the expense of other valuable education topics.
Yeah. Every hour on budgets is an hour not spent on math or science or history or art.
Right. There's a real opportunity cost. And that means policymakers and schools really need strong, clear evidence that adding finance is worth it. They need to know it's actually paying off for students, not just ticking another box while potentially sacrificing something else valuable.
Okay, so all those hurdles for past research, the mix of different programs, the timing issues, the aggregation problem that really sets the stage for this new study we're focusing on today.
Exactly.
So how does this research, the one by Brown, Collins, Schmeiser, and Urban, how does it cut through all that noise? How does it actually give us clearer, more reliable answers about the real impact? What do they do differently?
This is where their approach gets really clever. They understood those past limitations and designed the study specifically to tackle them head on. They wanted a much cleaner analysis.
So no more lumping everything together.
Right. Instead of trying to look at all states, which introduces all that messy variability, they zeroed in on just 3 specific states: Georgia, Idaho, and Texas.
Okay, why those 3? What was special about Georgia, Idaho, and Texas?
The key thing was that all 3 states implemented new mandatory personal finance course requirements in the exact same year, 2007.
The timing synchronization.
Yes, but it wasn't just the timing. Crucially, these states also had well-documented and specific requirements for their courses. The curriculum, the expectations, the graduation rules, they were clear and standardized within each state.
Okay.
And maybe most importantly for figuring out cause and effect, there were no other major curriculum changes happening in those states right at that same time.
So they could isolate the finance ed effect better.
Exactly. It provided this unusually clean experimental setup. It let them be much more confident that any changes they saw in financial behavior were actually due to the finance classes themselves and not some other big reform happening simultaneously. That kind of control is pretty rare in policy research.
Okay, that makes a lot of sense, a much sharper focus. So with this cleaner setup, how did they actually measure the impact? What methods did they use to really try and nail down causality and avoid those old pitfalls?
Well, this is where their methodological rigor really shines. They didn't just grab any old state for comparison, which could bring in all sorts of problems. First, they used a pretty advanced technique called the synthetic control method.
Synthetic control. Sounds fancy.
It is quite sophisticated, yeah. It was pioneered by researchers like Abadi, Diamond, and Hain-Mueller. Basically, for each of their treatment states, Georgia, Idaho, Texas, they mathematically constructed a synthetic twin.
A synthetic twin, like a statistical clone. How does that even work?
It's actually brilliant. It's a powerful tool for trying to figure out cause and effect. They created this synthetic twin by taking a weighted combination of other states that never implemented a similar finance ed mandate.
Okay.
But the weighting wasn't random. They meticulously calculated the weights to make sure the synthetic twin's demographic and economic trends before the policy change closely matched the actual trends of the treatment state.
So they built a hypothetical control state that looked just like, say, Georgia before Georgia started the finance classes.
Exactly. The goal was to build a perfect counterfactual. What would Georgia's credit trends have looked like if it hadn't implemented the finance ed policy? This synthetic twin represents that hypothetical scenario.
Can you give us an example? What did Georgia's twin look like?
Sure. For Georgia, the synthetic control was made up mostly of Kentucky, but also included smaller weighted contributions from Alabama, Alaska, California, Delaware, Hawaii, and Maryland.
Wow.
For Idaho, its twin was a mix of North Dakota, Nebraska, and Washington, and Texas's twin was built from California, Kentucky, and Mississippi. By matching trends before the policy, they could control for pre-existing differences and isolate the policy's unique impact much more effectively.
That's incredibly detailed. Really trying to isolate that one factor. And I think you mentioned they had a backup comparison method too, like a cross-check.
They did, yeah. As a robustness check, basically, to make sure their results weren't just an artifact of the synthetic control method, they also used a simpler border state approach.
Okay, what's that?
That just involves comparing the treated states to neighboring states that share a border but didn't have a similar mandate. So they compared Georgia to Florida, Idaho to Montana and Wyoming, and Texas to New Mexico.
Assuming neighboring states might be more similar in other ways.
That's the idea. Geographically close areas might share similar economic conditions or population characteristics that aren't easily measured.
Gotcha. So 2 different comparison methods. And how do they analyze the data within those comparisons?
For the core analysis, both methods used what's called a difference in difference framework.
Difference in difference. Can you break that down simply for us?
Sure. In essence, they look at the change in financial outcomes, like credit scores for students in the treated state, say Georgia, before versus after the policy started. Then they compare that change to the change in outcomes over the exact same time period for students in the control group, either the synthetic twin or the border state.
So you're comparing the difference over time in the treatment group to the difference over time in the control group.
Exactly. That helps to subtract out any general trends happening over time or any pre-existing differences between the groups. It's a standard and pretty effective way to try and isolate the causal impact of the policy itself.
Okay, that makes sense. So sophisticated methods. What about the data itself? You often hear about studies using surveys, asking people about their finances, which can be unreliable.
Right. People forget things or maybe don't want to admit they missed a payment. That's another key strength here. They used administrative data. Real data, not self-reported stuff.
Administrative data. From where?
Their main source was the Federal Reserve Bank of New York Equifax Consumer Credit Panel, the CCP. This is a massive, powerful data set.
Massive.
It's a 5% random sample of basically everyone in the U.S. with a credit report from Equifax, one of the big 3 credit bureaus. Plus, they include data for people living with those individuals. We're talking about 40 million credit files tracked every single quarter, going all the way back to 1999.
40 million. Wow.
Yeah. So they had access to actual real-world credit behavior, payment histories, debt levels, credit scores. Hard data, not just what people said they did.
That's huge for reliability. And who exactly were they looking at within that massive data set? Which individuals?
They focus specifically on young adults, right when they're starting their independent financial lives. Technically, they looked at individuals under the age of 22.
Okay.
They tracked each group or cohort of high school graduates for up to 4 years after graduation. They dropped people from the sample the quarter they turned 22. This gave them a window into that crucial early adulthood period where habits form and credit profiles get established.
And the sample sizes were big enough within those states.
Oh, yeah. They had about 60,000 individuals in the Georgia sample, around 12,000 in Idaho, and a really large sample of about 167,000 in Texas. Plenty of data to get reliable results.
Okay, real data, big samples, focused on young adults.
Yeah.
What specific things were they measuring in those credit reports? What were the key outcomes?
They looked at 3 main things to gauge credit health. First, Equifax risk scores. These are basically credit scores, typically ranging from 280 up to 850. Higher score, better credit risk, healthier finances.
Okay, credit scores. What else?
Second, delinquency rates. They measured whether someone had ever been 30 or 90 plus days delinquent on any credit account.
So missing payments by a month or even 3 months or more.
Exactly. On any kind of credit, student loans, car loans, whatever, it's a sign of financial distress.
Got it. And the third outcome?
Third, they specifically looked at auto loan delinquency. Same idea being 30 or 90 plus days delinquent, but just on an auto loan.
Why focus specifically on auto loans? And what about credit cards? Seems like credit cards would be a big one for young people.
That's a really sharp question, and it highlights how careful they were. They actually didn't use credit card delinquency as a main outcome.
Oh, why not?
Because of a major national law change.
What?
The Credit Card Accountability, Responsibility, and Disclosure Act of 2009, the CARD Act, remember that?
Vaguely, yeah. It changed the rules for credit cards.
It really did, especially for young people. It went into effect in early 2010 and made it much harder for anyone under 21 to get a credit card without an independent income source or an adult cosigner.
So it directly messed with credit card access for the exact age group they were studying.
Precisely. That national policy change would have muddied the waters, making it hard to tell if changes in credit card behavior were due to the state finance classes or the CARD Act. It would confound the results.
Okay. So they needed something else common for young adults.
Right. Auto loans were still a very common form of credit for young people, and they weren't really affected by the CARD Act in the same way. So using auto loan delinquency gave them a much cleaner, more reliable measure of how these young adults were handling debt.
That makes perfect sense. Smart move to ensure clean data. Okay, so before the classes kick in, what did these young adults' credit look like? What was the baseline?
Well, the summary stats in the study, Table 3 specifically, show pretty typical profiles for young people just starting out. Average credit scores were in the low 600s.
Low 600s.
Yeah,
That's great.
Not great, no. Often considered fair, maybe even poor credit. It reflects that they're often just beginning to build a credit history, but more telling were the delinquency rates.
How bad were they?
Over 10% of the observations showed someone being 30 days late on at least one account, and over 12% were 90 days or more late on any account.
Wow, 12% seriously delinquent.
Yeah. Auto loan delinquency was lower, around 3% for 30-day, 1% for 90-day, but still present. So this baseline clearly shows there was significant room for improvement. These young people were demonstrably struggling with managing credit as they entered adulthood.
Okay, so they had the right states, the clever methods, the solid data, the key outcomes, and a clear baseline showing a need. Now, how did they define the treatment? When exactly did the financial education start for these students in their analysis?
They were super precise about this, which is critical. The mandate for financial education started impacting the graduating class of 2007 in all three starts.
Okay, class of 2007 was the first group.
Right. So the researchers looked at the pre-treatment cohorts, those graduating from 2000 through 2006. Then they meticulously examined the post-treatment cohorts, the classes of 2007, 2008, and 2009.
And they tracked them over time.
Yes, and they specifically labeled these post-treatment groups Post 1, Post 2, and Post 3 to signify the first, second, and third graduating classes after the actual classroom implementation began.
Ah, implementation, not just when the law was passed.
Exactly. That distinction, focusing on when the rubber actually met the road in schools, not just when the politicians signed the bill, is absolutely crucial to their findings, as we're about to see. It's a key difference from a lot of prior work.
Right, but this raises a really important question, doesn't it? We know when the mandate started, but what kind of education were these kids actually getting in Georgia, Idaho, and Texas? Were the classes all the same, or did they vary a lot? Because that could make a big difference.
Fantastic point. They weren't all the same at all. Diving into the specifics of each state's mandate, which Table 1 in the paper lays out really nicely, is super insightful.
So what did they find? Any common ground?
There were some common features. All three integrated personal finance into an existing economics requirement, and they all had some form of standardized curriculum framework. But beyond that, the rigor and content differed quite a bit.
Okay, let's break it down. What about Georgia? You mentioned they were rigorous.
Yeah, Georgia seemed like the gold standard, really. Their mandate was approved back in 2004, but it wasn't fully implemented until the fall of 2006, hitting that first graduating class in spring 2007.
Okay. And the course itself?
It was a required year-long course called Let's Make It Personal, developed by the Georgia Council for Economic Education. And it wasn't just personal finance. It covered microeconomics, macroeconomics, international economics, plus substantial personal finance topics: planning, saving, insurance, credit.
Pretty comprehensive.
There. They even included active stuff like stock market simulations. The study notes it was intensive, and importantly, it included required performance testing. The goal was explicitly to prepare students as workers, consumers, and citizens.
So deep content, practical application, and accountability through testing.
Exactly. Broad learning objectives, too, applying rational decision-making, understanding financial institutions, policy effects, credit cost benefits, insurance, earnings, a really dedicated effort.
Okay, Georgia sounds serious. What about Idaho? You hinted they were less rigorous?
Yeah, Idaho was definitely a lighter touch by comparison. Their mandate actually came earlier in 2003 with pretty general language about stressing financial literacy, budgeting, investments, bankruptcy, etc.
So specific direction.
Seemed like it. For the class of 2007, this translated into just a one-semester economics requirement taught as part of social studies.
Half a year, not a full year like Georgia.
Right. And the content breakdown was interesting. About 20% was traditional economics. Then they had chunks on personal finance, 15% on credit and debt, scores, loans, 20% on saving and investing, 20% on money management, pay stubs, taxes, cost benefit. The rest covered family finance, job applications, consumer rights, fraud, goal setting.
So it touched on key topics, but in less depth.
Seems that way. A shorter course, and critically, no mandatory testing associated with it. That significantly reduces the intensity and maybe the focus compared to Georgia.
Okay, so Idaho, half year, no testing.
Dot.
And Texas. Where do they fall on this rigor spectrum? More like Georgia or Idaho?
Texas was much more like Georgia, rigorous and comprehensive. A 2004 amendment required economics classes in grades 9-12 to include personal finance, starting with the 2006-2007 school year.
Similar timing to Georgia's implementation.
Right. And they had standardized materials approved by the State Board of Education, ensuring consistency across the state.
And the content.
The list of minimum topics was really extensive and very practical. Things like understanding interest, avoiding credit card debt, renting versus buying a home, starting a business, prudent investing, stocks, other options, savings, retirement, bankruptcy, balancing a checkbook, types of loans, insurance, even charitable giving.
Wow, that covers a lot of ground.
It really does. And like Georgia, it was structured within a year-long economics course and had specific testing requirements. So a clear commitment to both breadth and depth, very similar to Georgia's approach.
Okay, so we've got two states, Georgia and Texas, with rigorous year-long programs that included testing, and then Idaho with a less rigorous half-year program without testing. That contrast is going to be really important for understanding the results, isn't it?
Absolutely. That variation in program design, combined with the precise timing and the great data, is exactly what allows this study to offer such unique insights and potentially explain those mixed findings from the past.
All right, the moment of truth. We've got the careful setup, the right state, the clever synthetic controls, the real-world credit data, the detailed look at the actual classes. So after all that meticulous work, what do they actually find? What does this all mean for whether financial education actually works?
This is really where the study's main message comes through, loud and clear, and it's powerful. Time and, crucially, precise implementation matter enormously. Well, first, if you look at the graphs in the paper, Figure 4, you see the trends before implementation. For things like credit scores, the lines for the treated states and their synthetic twins track each other very closely. They're largely parallel.
Which means the synthetic controls were working, right? They were good comparisons.
Exactly. It validates the method. The twins really did behave like their real counterparts before the policy hit. But then, after 2007, you start to see a divergence. Subtle at first, but growing clearer over time, positive shifts appearing in the treated states that you don't see in the synthetic controls.
Okay, so let's get specific. Table 4 lays out the main findings year by year after implementation.
Right.
Let's start with Georgia, the rigorous year-long program with testing. What happened there?
Georgia showed really strong, positive, and consistently increasing effects over time. Just what you'd hope for from a solid program.
Increasing. How?
Okay, look at credit scores. For those young adults who went through the program, their scores were up by only about 0.7 points in the first year after implementation, post-1. Pretty small.
Barely noticeable.
Right. But then in the second year, post-2, scores jumped by a significant 13.4 points. And in the third year, post-3, they were up by a really substantial 28.7 points.
Wow, nearly 29 points higher after 3 years.
Yeah. And those increases in year 2 and 3 were highly statistically significant, meaning it's extremely unlikely they happened by chance.
What does a 29-point jump mean in the real world for a young person?
Oh, it can be huge. That could easily be the difference between getting approved for your first apartment or denied, or qualifying for a much lower interest rate on a car loan, saving potentially thousands of dollars over the life of a loan. It's not just a number. It translates to real financial advantage.
That's a serious impact. Okay, what about delinquency? Were they better at paying bills on time?
Yes, consistent improvements there too. For delinquency on any account, the 30-day rate being 1 month late dropped by 1.5 percentage points after 3 years of exposure.
How big a deal is 1.5 percentage points?
Well, Georgia's average 30-day delinquency rate in the sample was about 15.6%. So a 1.5-point drop means roughly 10% fewer young adults were 30 days late. That's a noticeable improvement in financial stability for that group.
Okay. And the more serious delinquency? 90 days late.
Even better results there. The 90-plus day delinquency rate fell by a very significant 3.6 percentage points after 3 years.
3.6 points.
Yeah. Given Georgia's average 90-plus day rate was around 17.8%, this means about 20% fewer young adults experienced that kind of severe delinquency. That's a really remarkable outcome preventing serious financial trouble.
20% fewer. That's huge. And what about those auto loans, the cleaner measure?
Also positive, especially for avoiding initial trouble. 30-day auto loan delinquency dropped by 1.7 percentage points after 3 years. Now, the base rate for that was only 3.4%.
So a 1.7-point drop is cut in half.
Exactly. A whopping 50% reduction in 30-day auto loan delinquency. That's incredibly impactful for kids making their first big purchase. The effects on 90-plus day auto delinquency were smaller, probably because that's rarer anyway, but the overall trend for Georgia, clearly positive and getting stronger over time.
That increasing effect over time is interesting. Why do you think it wasn't immediate? Why did it grow from year 1 to year 3?
That's a great point. The study suggests it's likely linked to Georgia's intensive curriculum. Think about it. Teachers were probably learning too, getting better at delivering this complex material, maybe refining how they taught it.
So the program itself might have improved.
Plausibly, yes. As teachers' ongoing learning and tailoring of the content happened, the program likely became more effective each year. It wasn't just flipping a switch. It was more like a refinement process leading to bigger benefits over time.
That makes a lot of sense. Teacher experience, curriculum settling in. Okay, now let's pivot to Idaho. Less rigorous program, half year, no testing. How did the results stack up against Georgia's big gains?
Idaho's picture is definitely more muted. The effects were generally smaller, and crucially, they were delayed. It really seems to underscore the impact of program rigor.
Delayed how?
Well, look at credit scores again. In the first year, post-1, Idaho students actually showed an initial decline of about 7.3 points.
A decline. Scores got worse at first.
Yeah, quite curious, right? A negative dip initially. But then in post-2, scores went up by about 2.2 points, and by post-3, they were up by 6.5 points. So it did eventually turn positive, but it took longer, and the final gain was much smaller than Georgia's 29 points.
That initial drop is really fascinating. Any theories why? Could introducing complex ideas without enough depth actually make things worse initially, like making kids aware of risks but not fully equipping them?
That's a really insightful thought, and it seems plausible. That negative start and the slower path to positive results fit well with Idaho's less rigorous program.
Right, half year, no tests.
Exactly. Maybe it took longer for schools to figure out how to teach it effectively, or for students to really grasp and apply the concepts with less intensive exposure. Your point about awareness without tools is interesting. Maybe a little knowledge, poorly delivered, could initially increase anxiety or confusion before the benefits kick in.
Okay, what about delinquency in Idaho?
Not much impact on the 30-day delinquency rate, but they did see some reductions in the more severe 90-plus day delinquency, down 1 percentage point in post-2 and about 0.7 points in post-3.
Smaller than Georgia's 3.6-point drop.
Definitely smaller. For auto loans, they saw significant reductions, especially in 30-day, down 0.7 points in year 2, 1.2 points in year 3, and also some effect on 90-plus day later on, down 0.9 points in year 3.
So some positive effects eventually, particularly on auto loans, but generally smaller and slower than Georgia.
Exactly. It strongly suggests that while even a less intensive program might have some benefit, it likely doesn't pack the same punch as a more comprehensive, rigorous approach like Georgia's.
Okay, makes sense. Less input, less output, perhaps. Now, what about Texas? They also had a rigorous year-long program with testing, like Georgia. Did they see similar success?
Largely, yes. Texas showed significant and increasing effects, mostly mirroring Georgia and reinforcing that message about robust programs mattering.
Mostly mirroring. Any differences?
Well, for credit scores, Texas also had a small negative dip in the first year, post-1, down about 1 point, similar to Idaho's start.
Interesting. Another initial dip.
Yeah, but then it took off. Scores increased strongly in post-2, up almost 5 points, and post-3, up 13 points. So again, maybe a brief adjustment period, but followed by substantial growing gains, though not quite as large as Georgia's 29 points.
Still, 13 points is a solid improvement. What about delinquency in Texas?
Here, they saw no statistically significant effect on the 30-day delinquency rate for any account. But importantly, they saw large and significant reductions in the severe 90-plus day delinquency across all 3 post-implementation years.
So really helping prevent serious financial trouble.
Seems so. Those reductions grew over time, too. Young adults in Texas were 0.8 percentage points less likely to be 90-plus days delinquent in post-1, rising to 2.2 points less likely in post-2, and a significant 3.3 points less likely in post-3.
How does that 3.3-point reduction translate in real terms for Texas students?
Texas's average 90-plus day delinquency rate was about 15.9%. So a 3.3 percentage point reduction means about 20.7% fewer severe delinquencies among those young Texans who got the education for 3 years.
Wow, almost identical percentage reduction as Georgia. Over a fifth fewer kids in serious trouble.
Exactly. So despite maybe a slightly slower start than Georgia on credit scores, the long-term impact on preventing severe problems was very robust in Texas, too. It shows these well-designed, comprehensive programs really really can pay dividends.
Incredibly compelling. Georgia and Texas showing strong results. Idaho showing some results, but weaker and delayed.
Yeah.
It really points to program design and intensity. And didn't they do that robustness check using the border states? Did that back this up?
They did, and it absolutely did. It really strengthens the conclusions. Table 6 in the paper shows the results using those geographically neighboring states as controls. And the findings were generally consistent with the synthetic control results.
Consistent. Or even stronger.
In some cases, actually substantially larger. For example, using the border state comparison, Idaho's credit score increase after 3 years was 16 points, much bigger than the 6.5 points from the synthetic control.
Whoa.
And Texas saw an almost 32-point increase in credit score using border states compared to 13 points with the synthetic twin. The reduction in 90-plus day delinquency for Texas was also larger, 5.8 percentage points versus 3.3 points.
So if anything, the synthetic control might have been conservative in its estimates.
It certainly seems that way in some cases, but the key takeaway is the consistency. Getting similar positive results using two different plausible comparison methods gives you a lot more confidence that these effects are real and not just some fluke in the data or the methodology.
Okay, so the evidence looks pretty solid that these specific programs, especially the rigorous ones, really worked when implemented properly. But now we get to that crucial twist, right? The thing that might explain why past research was so messy. The difference between passing a law and implementing it.
This is huge. It's maybe the biggest takeaway from this paper for anyone studying policy, not just finance. It potentially explains so much of the confusion in earlier literature.
What did they do? They reran the analysis using the wrong start date.
Essentially, yes. They redid everything, but this time they used the year the mandate law was passed as the start date for the treatment. 2003 for Idaho, 2004 for Georgia and Texas, instead of the actual 2007 implementation year.
And what happened? Was it really that different? Because if so, this is massive for how we evaluate policies.
It was a night and day difference, totally dramatic. When they used the earlier mandate year as the start date, the results were consistently lower magnitudes and less precisely estimated.
Meaning smaller effects and less certainty.
Exactly, and often less intuitive. You didn't see that nice, steady improvement over time like you did when measuring from the implementation year.
Any specifics?
For Idaho, using the mandate year, credit scores were actually consistently negative across all 3 years. It made the program look actively harmful, which we know wasn't the case later on.
Wow.
And for all states, many of the delinquency effects just weren't statistically significant anymore. It looked like the programs did nothing for delinquency. For Georgia, the credit score effect looked smaller and didn't grow consistently. Same for Texas, smaller effects that didn't show that clear upward trend.
So using the wrong start date completely obscured the positive effects.
Completely, or drastically understated them. It leads to this huge realization, if we connect this to the bigger picture, it strongly suggests that getting the timing of policy implementation right is absolutely crucial to accurately estimating the effects.
It's not enough to just know a law passed.
Not at all. You have to know when it actually reached the classroom. When was the curriculum ready? When were teachers trained? When did students actually start learning this stuff? If you don't pinpoint that actual start date, you're basically measuring noise, or the effects get so diluted you can't see them. You might wrongly conclude a perfectly good policy doesn't work.
This study really drives home that difference between political action and real-world classroom impact.
It really, really does. A critical lesson for policy evaluation.
Okay, let's pull all this together. We've gone deep into the methods, the data, the findings. What does it all mean for us, for you listening, and maybe for policymakers thinking about these programs? What are the big takeaways?
Well, the study makes several really important contributions. First, and maybe most obviously, it provides strong confirmation that financial education can be effective. But, and this is a big but, it's not a blanket statement.
Right. It's about specific types of programs.
Exactly. It demonstrates that these 3 standardized and relatively rigorous education programs do appear to alter credit behavior in early adulthood. The emphasis is on standardized, rigorous, and well-implemented programs.
And that ties right into what you call the massive implementation lesson, right? Probably the biggest insight for how we study policy.
I think so. It just hammers home how vital it is for researchers and policymakers, too, to focus on documenting and testing the actual implementation of programs in the classroom rather than simply using the year of enactment. That distinction is key to getting clear results.
What else?
Second, the study really shows the power of using that administrative credit report data. It's an objective downstream measure of actual financial behavior. It lets us see the real-world impact of education in a concrete way, moving beyond just surveys about knowledge or attitudes.
Hard data on outcomes.
Exactly. And third, methodologically, it shows the synthetic control method works well in this context, especially with that border state comparison backing up the findings. It advances the toolkit for policy evaluation.
Okay, so it works under the right conditions. Implementation timing is crucial, and good data helps prove it. What about the size of the impact? How significant were those 7 to 29-point credit score increases or the delinquency reductions for the average kid?
They're actually quite significant, especially in the world of educational interventions where moving the needle can be tough.
How significant?
Well, that 7 to 29-point increase translates to about 0.08 to 0.33 standard deviation units, statistically speaking. The study authors note these are relatively large in magnitude effect sizes compared to what many other studies on financial ed or even other educational programs often find.
So bigger effects than often seen.
Potentially, yes. And remember, for a young adult starting out, even a 10 or 20-point difference in credit score can mean real money saved on loans or getting access to credit or housing they might otherwise be denied. It's meaningful.
And the link to the delinquency reinforces that, right? It wasn't just scores going up magically. It was tied to better behavior.
Absolutely. The study clearly states the score improvements were driven by reductions in the incidence of delinquencies. It strongly supports the idea that the education genuinely boosted financial capability and cash flow management.
They learned to handle their money better, pay bills on time, avoid serious debt traps.
That's what the data suggests. Less stress, more stability, a better financial footing for the future.
Okay, this all sounds incredibly positive. A real win for targeted education done right. But the paper itself brings up that tricky issue, the opportunity cost problem. Even if it works, there's always a trade-off in the school day, isn't there? This is where it gets complicated for schools.
It does, and the authors are commendably upfront about it. They state very clearly, given that there is a finite amount of time in the school curriculum, an expansion of financial education courses invariably comes at the cost of less time devoted to other subjects.
Right. You had a year of finance. What gets cut or squeezed?
Exactly. Does it mean less time for advanced math or science, less history, fewer electives like art or music, less career and technical training? That's the tough calculations schools and districts have to make.
So it raises this really important question for all of us, doesn't it? Even with these clear benefits, we have to weigh the trade-offs. What might kids not be learning because they're learning about finance? Is the benefit here definitely outweighing the potential cost in other areas? That's not easy to answer.
It's far from easy, and it highlights why we need rigorous evaluation of all parts of the curriculum, not just new additions. The study authors themselves acknowledge this. They basically say they leave it to subsequent research to determine whether these positive effects persist further into adulthood and to weigh the costs of providing financial education in school relative to its benefits.
So more research needed on how long the effects last and on that cost-benefit calculation.
Definitely. We need that longer-term view. Do these kids continue to have better credit outcomes 5-10 years down the road?
Yeah.
And what's the real return on investment for the state, for the individual, when you factor in teacher training, curriculum costs, and the value of the time taken from other subjects? Those are critical next questions.
And so maybe the final thought to leave our listeners with is this. If the goal is to improve things like debt repayment and financial stability for young people, and we see that these kinds of specific, well-implemented programs can produce such clear results, what does that tell us about the power of practical, targeted education?
It certainly suggests that how we teach and when we teach it, focusing on real-world application and ensuring quality implementation, can make a profound difference in preparing young people for the financial realities they'll face.
It's not just what's in the textbook, but how it gets translated into usable skills. A lot to think about.
It really is. A powerful reminder that execution matters just as much, if not more, than the initial idea. This study gives a strong nudge towards smart, deliberate design and implementation.
Well, that wraps up another deep dive. We've seen compelling evidence that the right kind of financial education, delivered effectively and tracked rigorously, really can make a positive difference in young adults' financial lives, helping them build better credit and avoid costly mistakes.
And these are exactly the kinds of well-researched, sometimes surprising insights the deep dive aims to bring you. We hope it helps you feel better equipped to understand the forces shaping our world.
Join us next time as we tackle another set of sources looking for those hidden connections and crucial details. Until then, thanks for joining us for this